You have 5 minutes until the quiz ends in Connect. You have 3 minutes until the quiz ends. Save your answer. The quiz will end in 2 minutes. Save all your answers not to lose them. The quiz will end in 1 minute, so save all of your answers. Okay, the quiz ended, so I will enable the chat function. And I also let you unmute. Yeah, I allowed you unmute if necessary. Okay. Then let's start the class. So I will share the, all right. So today we continue with chapter 9, capital budgeting decision. So on Monday, we started discussing how corporations decide which project they need to accept and which ones they should reject. So to make that kind of investment decisions, there are 6 tools available. And the most important tool is NPV. The reason is NPV considers the time value of money concept, and NPV considers the riskiness of the project. Also, NPV tells us how much value this new project will provide for the owners of the corporation, meaning the stockholders. So that's why NPV is the most important tool for capital budgeting decisions. So there are several ways of calculating NPV. You can use your financial calculator, and you can also use Excel. So this spreadsheet, this slide shows you how to calculate NPV using Excel. So when you can use Excel's NPV function. And the first component in the NPV is the required return, and it should be entered as a decimal. And the second component is the range of cash flows beginning with year 1. So don't include year 0 cash flow, start from year 1. And then you subtract the initial investment to calculate NPV. And I think the person Microsoft hired to develop the NPV function, I think that person did not learn finance. So that's why NPV function in Excel was developed this way. But we cannot change it. So why not including year 0 cash flow? Yeah, it's kind of weird, but we need to follow that rule. So yeah, when you click Excel, the Excel icon, I click the Excel icon, and Zoom tends to not displaying the clicked one. So I stop the share and I will share the Excel file again. So when you click it, you can have this kind of Excel spreadsheet opening. So to calculate NPV, you use the NPV function. Let me make it a little bigger so that you can see well. So you are using this 3-year project. Initial investment is $165,000. So from the company's point of view, that's an initial investment. So cash outflow, that's why cash flow 0 is negative. So it's a typical conventional investment activity. So usually when firms start a new project, they need to buy equipment and buy raw materials. So at the beginning, there is a large cash outflow. But using those initial investment, the purchased assets and other materials, and also hire workers and pay wages. So that initial investment leads to inflows, profits, cash flows. So cash flow from assets generated. So year 1, 2, 3, there are positive cash flows. So that's a typical cash flow stream of an investment project of a corporation. So we are using this simple 3-year project numerical example to learn how to use Excel to calculate NPV. So Excel's NPV function, the rule is the first component is the required return, because NPV is the net present value. So meaning that future cash flows are discounted properly, and then we subtract the initial investment. So we need the discount rate. So the right discount rate for this project, this cash flow, is 12%. So it's given in the problem set. So 12% is the discount rate. So Excel's NPV function requires that you enter the discount rate in decimal. So 12%. So that's 0.12. And then it's important. Where should we start selecting the cash flows? You don't start from cash flow 0 when you use Excel's NPV function. You start from C2, that's cash flow 1, 2, and 3. The future cash flows you include, and then what you need to do is you need to subtract the initial investment. But the initial investment included in cell B2 is already negative. So that's why you add it. But if this number is positive and this is a cash outflow, you subtract it. So you need to be careful what's given. So should it be positive or negative? You need to understand. So what's going on. So Excel, again, let me emphasize. So I'm emphasizing once more that don't select B2. The first cell, Excel's NPV is not designed that way. So it's kind of confusing, but when you use technology, you need to understand the rule of the technology and follow it. Otherwise, you will not be able to get the right answer. Okay, this is how to use Excel to calculate NPV. Do you have any questions? Okay, so again, let me emphasize once more. It's not difficult to calculate NPV using Excel, but if you don't practice, it's very easy to make mistakes. So that's why I give you problem sets in Connect, as well as there are many examples, numerical examples in the slides. So you need to practice. If you don't have any questions, let me go back to the slide. All right, so we finished the NPV calculation. Now we move on to another capital budgeting tool, and that is Payback rule. So Payback rule is simple. Simply speaking, how long does it take to get the initial investment back in a nominal sense? So you estimate the cash flow and subtract the future cash flows from the initial cost until all the initial investment has been recovered. So the decision rule is accept the project if the payback period is less than some preset limit. So let's use the numerical example to calculate the payback period of this 3-year project. And to apply the payback rule, there should be a preset limit. So suppose this company's policy is to accept the project if the project pays back within 2 years. So if that's the rule, how long does it take this project, this 3-year project, to pay back? So initial investment is 165,000. The first year after this investment is made, 1 year after 1 year, $63,120 will be earned. So after this, the remaining balance is 101,880. It's just simply 165,000 minus 63,120. So there is still this negative balance. So what happens after another year? So during the second year, 70,800 will be remaining. So you just subtract 70,800 from this 101,880. So the difference is 31,080, and that is still to be recovered. So that's why it has a negative sign. So after 2 years, we still have a negative balance. That means this 3-year project does not pay back within 2 years. So we go one more year, another year, the year 3, 91,080. So this is enough to pay 31,080 balance. So we need proportionally how long it takes. So we divide the remaining balance at the end of the second year divided by 30-year cash flow. So it's 0.3412. So that means it takes 2.34 years to pay back this project. So the decision rule is paid back within 2 years. So this project will be rejected. Any questions so far? You may wonder what's the basis of 2 years limit, preset limit? There is no scientific definition of those limits. It's just a quick and dirty method. So payback rule is like a quick and dirty method of very simple, but in the real world, we need to think of the balance between benefit and cost. So if a company is doing just corporations need to make a lot of investment decisions, starting from huge project that requires a very large amount of capital. So for example, if this new product development, it's succeed or failure, that will determine the future of the company. So that kind of huge, important project versus decisions versus, shall we replace this refrigerator or not? Shall we use more energy efficient light bulbs, or we just keep the current ones? So there are huge different ranges of investment decisions in a company. So when companies make a very important and large investment decisions, they need to do NPV, but small decisions, day-to-day decisions like replacing light bulbs or equipment, that kind of decisions, they don't have time to do all those complicated analysis. Just to apply simple rule. Yeah, it can be 2 years, it can be 3 years. So what if? So it depends on what kind of capital budgeting decision. The CFO's office, for example, gives a guideline to engineers in the field. So when you make that kind of investment that's under $100,000 in replacement of an equipment, payback period is 3 years. Or 2 years. So that kind of a simple guideline. In that kind of situation, payback period is useful. So the next slide shows, does the payback rule account for the time value of money? No, we didn't discount. We just used the nominal number. So simple payback rule does not consider the time value of money. Does the payback rule account for the risk of the cash flows? No, we didn't consider. We didn't have any mechanism when we calculated the payback period that's related to the riskiness of the cash flows. So no, the answer is no to the second question. Does the payback rule provide an indication about the increase in value? No. How much money this new project generates for the company? We don't know from the payback rule calculation. So should we consider the payback rule for our primary decision criteria? The answer is definitely no. But as I mentioned before, this kind of simple method has some uses in the real world. So that's why you're learning. So this slide summarizes the advantages and disadvantages of the payback rule. So advantages is it's easy to understand, very intuitive, right? So how long does it take to recover the cost? So easy to understand. And another important benefit is it automatically adjusts for the uncertainty of later cash flows. So by definition, we are looking at risky projects. So we need the cash flows estimated, the faraway cash flows estimated inherently have a lot of uncertainty compared to the near-term forecast. So long-term forecasts are difficult to everybody. So no matter what, how much expertise that analysts have, long-term cash flows are inherently more risky, more uncertain than short-term forecast. So, but when we calculate the payback rule, the faraway cash flows usually doesn't matter because as long as how long does it take to pay back, we just consider earlier cash flows. Longer-term cash flows don't play any role in payback rules. So that's an advantage. It's automatically, payback rule automatically adjusts for uncertainty of later cash flows. But, and also, this is also an advantage as well as disadvantage, but payback rule prefers projects that pays back early. So it's good for in terms of liquidity. So cash is recovered better. If we just use payback rules, it biases toward the project that pay back early. So cash is recovered fast, so that's good in terms of liquidity. Okay. But payback rule has many disadvantages. As I mentioned before, payback rule ignores the time value of money and requires an arbitrary cutoff point. Nobody knows why we use 2 years, 3 years. It's just a simple guideline. There is no theoretical reasoning, just for convenience and in terms of saving time and efforts to evaluate many projects. So just the cutoff point is arbitrary. And payback rule ignores cash flows beyond the cutoff date. So this payback rule is biased against the long-term project like R&D and long-term important, but long-term and may not generate values near-term, but good for the company's future in the long run. That kind of project will not be valued well if the company uses the payback rule. So that's a disadvantage. But most companies do not apply payback rule for that kind of long-term R&D research-related projects. So for that kind of project, definitely NPV needs to be used. So any questions so far about the payback rule? If you don't have any questions, let's move forward. So another tool is to fix that some of the shortcomings of the payback rule. So this is discounted payback rule. So discounted payback period computes the present value of each cash flow and then determine how long it takes to pay back on a discounted basis. And again, the discounted payback period requires a preset limit, the required period. Also, discount rate is needed. So the decision rule is accept the project if it pays back on a discounted basis within the preset limit. So applying the same, applying this rule to the example, numerical example we have been using. So year zero cash flow, no difference, 165,000. It's a near zero cash flow, so discounting doesn't matter for this present value. It's already present value. But the year one cash flow, 63,120, that should be discounted. For how long? 1 year, because it's a year one cash flow. So how to discount? Using the 12% discount rate. So after 1 year, how much is the balance? So 643 is the remaining balance in terms of present value. And then after that, you apply the second year cash flow. It should be discounted twice by dividing that year two cash flow by 1 plus 12% to the power of 2. So after year two, this remains. So, and still we have a balance greater than 0. So after year 3, what happens? The third year cash flow discounted 3 times to convert it into present value. So this project pays back in 3 years. So should we accept the project or reject the project? We should reject the project. Why? Because the preset limit is 2 years, but this project, it takes more than 2 years. It takes less than 3 years to pay back, but the rule is should be paid back within 2 years. So we reject the project based on the discounted payback rule. So this is how discounted payback rule works. Any questions so far? No? Okay, then let's move forward. So does the discounted payback rule account for the time value of money? The answer is yes. Does the discounted payback rule account for the risk of the cash flows? The answer is no. Discounted payback rule account for the risk of the cash flow? It's kind of yes, kind of yes, yeah, actually yes, because we are using a risk-adjusted required return. So it's okay in terms of that risk component because we are using a discount rate based on the riskiness. Does the discounted payback rule provide an indicator about the increase in firm value? The answer is no. So we don't know how much value this project creates for the company. So that's why we should not consider the discounted payback as our primary decision-making tool. So the advantages of and disadvantages of discounted payback rule. Advantages include, it includes time value of money. It's easy to understand, and it benefits projects that provide higher liquidity. So that's a good thing. But disadvantages is discounted payback rule may reject positive NPV investment, and it requires arbitrary cutoff, and it ignores cash flows beyond the cutoffs. So it again, discounted payback again is biased against the long-term projects like R&D. So we finished NPV payback rule and the discounted payback rule, and then we move on to the fourth decision-making tool, which is average accounting return. The problem of this average accounting return is there is no universal definition. Many people use the term average accounting return, but their definitions vary. So some books use this definition, other books use these definitions, and some practitioners define it a little differently. So it's hard, but I follow your textbook's definition because your textbook is the most widely utilized textbook in corporate finance classes in finance. So the definition used in your textbook is average net income divided by average book value. That's the definition of the average accounting return. And note that we are using net income instead of cash flows. That's one thing you should note. And we are using book value to calculate the return. And definitely book value is dependent on the depreciation schedule. So again, this average accounting return needs a target cutoff rate, and it's arbitrarily set. And the rule is accept the project if the average accounting return is greater than the preset rate. So let's use a numerical example. So you use the same numerical example, but in the same numerical example, there are cash flows and net income are given. And you remember from chapter 2, cash flow from assets, that's different from net income. So you learned how to calculate cash flow from assets. So in previous tools, we used the cash flows, but for average accounting return rule, we use net income instead of cash flows. So what's the average net income? So we have 3 years. So 3 net incomes are divided by 3. So that's the average. In an average year, this project generates $15,340 of net income. And the average book value is also given in the problem, so 72,000. So average accounting return is 21.3%, but the preset limit, the target return is 25%, but this project will generate only 21.3%, but the target is 25%. So we reject the project because this project is not generating enough return. So that's how to use average accounting return for capital budgeting decisions. So any questions so far? No? Okay, let's move on. So does the average accounting rule account for the time value of money? The answer is no. We treated year 1, 2, 3 net income in the same way. We didn't discount or anything. So our average accounting rule ignores the time value of money. So does the average accounting return rule account for the risk of the cash flows? No, we didn't consider any information that much related to the riskiness of the project. So average accounting return does not consider the riskiness of the cash flows. It doesn't even use cash flows data. It just use accounting net income. So the answer to the second question is definitely no. Does the average accounting rule provide an indication about the increase in firm value? No, the answer is no. So should we consider the average accounting rule for average accounting return rule for our primary decision criteria? Definitely no. And the next slide, we just take a moment to think about the advantages and disadvantages of using this rule. Easy to calculate. So whenever we have a pro forma income statement, we can easily calculate it. And the needed information will usually be available. Yeah, so the financial statements data is easy to get. If it's a pro forma, it may be a little more difficult, but still, compared to other information, finding net income is definitely easier than finding other information. Disadvantages, it's not a true rate of return, and time value of money concept, important concept, is ignored, and also arbitrary cutoff target rate should be set, and nobody knows why. Just it's not an arbitrarily picked rate, but there's no firm ground. And based on the accounting net income and book value, not cash flows and the market value. So in terms of financial decision making, we know book values and market values are quite different, and we know cash flows and net income are quite different. So in finance, we focus on value, market value. So that's a problem of average accounting return. But still, many people use it. Many people use that average accounting return. So that's why you learn it. Yeah. But that's definitely not our primary decision-making tool in finance. So the last one, not the last one. Yeah, we have this one and profitability index. So the second important tool next to NPV is IRR, the internal rate of return. So this is the most important alternative to the net present value rule. And it's very widely utilized in the real world because it's very intuitive. And another important reason is NPV requires very important two inputs, cash flows and the discount rate, the required return. Both are very difficult to estimate. Estimating cash flows, that's a challenge. And as finding the right discount rate is also a challenge. One of the biggest appeals of IRR is IRR does not require the discount rate because IRR is the discount rate. Of course, we need to compare how high is the IRR. So we need some kind of guideline. So if IRR is higher than this rate, we accept the project. If not, reject the project. So that kind of cutoff, we still need it. But for calculation, in terms of calculation, we do not rely on the discount rate because IRR is the discount rate. Why it's beneficial? Because if IRR is high enough, we don't have to think about the required return that level. So in many cases, it's kind of obvious. Similarly, if IRR is just low enough, we can easily reject it. So without making efforts, how high should be the cutoff rate? So that's a tough decision, but for many projects, it looks just obvious, too high, very low, then we don't need to worry about what should be the cutoff. So that kind of advantage IRR has, so that's why in the real world, a lot of people use IRR. So so that's what I meant here. IRR is based entirely on the estimated cash flows and is independent of the interest rate found elsewhere. So required return is not needed. The discount rate is not needed in the calculation of IRR. So it's very important for you to remember this definition. What do we mean by the internal rate of return? Internal rate of return is the discount rate that makes the net present value of this project equal to 0. So you can think of IRR as the break-even discount rate that makes the present value of future cash flow equal to the initial investment. So how the cost, its initial investment, and benefits, present value of future cash flows equal. So costs and benefits equal. What kind of discount rate that makes this project break even? So that's the internal discount rate. So the decision rule is accept the project if the IRR of the project is greater than the required return. If not, reject the project. So let's use the numerical example. So you should have a financial calculator or an Excel spreadsheet to calculate it. If you just have a regular calculator, calculating IRR will be a very painful process because you need to have a trial and error method. If you just want to use a regular calculator, and I don't definitely recommend that. It's going to take too long. So you should use either a financial calculator or an Excel spreadsheet. It's similar to yield to maturity calculation you learned in chapter 7. So to calculate the yield to maturity of a bond, if you don't have a financial calculator or an Excel spreadsheet, you need to use a trial and error, but don't do that. It takes too long. So this you enter the cash flow just like you did using NPV, calculating NPV using the financial calculator. Use the slide I presented on Monday and just choose IRR instead of NPV. That will give you the IRR calculation if you want to use a financial calculator. But if you want to use the Excel spreadsheet, simply use the IRR function in the Excel file. So here IRR, you calculating IRR with the spreadsheet. So you can follow this instruction here. So if you click this, you can open the Excel file. I'll just let me stop share and reshare. Okay. It's here. So IRR. So you just you choose the cash flow B2 to E2. So you enter initial cash investment cash flow negative and year 1, 2, 3 cash flow positive. And remember, IRR does not need the discount rate because it is the discount rate. So there is no discount rate, 12%, you don't select that. And in IRR calculation, you should start from year 0 cash flow to the end. Select all the cash flows, not just the year 1, 2, 3. So if you use IRR and function and select those all those cash flows, you will get 16%. But by default, Excel shows the whole number, but it's not accurate enough. So how to adjust it? You calculate, you click the home button and you click this arrow pointing to the left. It will increase the decimal, so just increase. So usually you need to show 2 decimal places. So this is how to use Excel's IRR function. Any questions so far? Right. Then let's go back to the presentation slide. So everybody should be able to calculate NPV and IRR and others like payback, accounting, average accounting return, discounted payback. So you should be able to do the calculation as well as understand the logic concept behind those tools. So IRR is the 16.13%. So the meaning is up to the discount rate of 16.13%, this project have a positive value. So IRR 16.13% is definitely higher than 12%, the required return. So this project has a positive NPV. So IRR is greater than the required return of 12%. So we accept this project. So this chart in this slide shows the relationship between the discount rate and the net present value of this project. Remember, the net present value of a project depends on the discount rate. So the higher the discount rate, the lower the present value. So there is an inverse relationship between the discount rate and the present value. So this chart shows how high is the NPV when we are using different discount rates. So when we use 12%, there is positive NPV. So NPV 0 equals to 16.13% discount rate. So the definition of the IRR of a project is the discount rate that makes the NPV equal to 0. So that this slide shows the graphical illustration of this relationship among the discount rate, NPV, and IRR. So any questions so far? So the decision criteria test for IRR is, does the IRR rule account for the time value of money? Yes, it involves the time value of money. It's the discount rate. So the answer is yes. Does the IRR rule account for the risk of the cash flows? The risk of the cash flows, it's hard to say, but not a definitely yes is not the definite answer, because we don't consider the riskiness of project here. So indirectly it has some kind of relationship, but risk is not explicitly adjusted when we apply the IRR rule. Does the IRR rule provide an indication about the increase in value? How much value increase? It's not a clear answer. There's no clear answer. So should we consider the IRR rule for our primary decision criteria? The answer is no. It's a good criterion, but it's not definitely the best one. But still, IRR has many advantages. So knowing the internal rate of return is intuitively very appealing. So that's why it's a very widely used tool. So it's a very simple way to communicate the value of a project to someone who does not know all the details in financial decision making. So if the IRR of a project is high enough, you may not need to worry about estimating the required return because it's a very challenging task. So making it unnecessary, it's a huge benefit. And the next slide I already explained. So this is the summary of applying those 5 rules of the sample project. So the next slide shows a quick comparison between NPV and IRR. So good news is NPV and IRR usually give us the same answer, accept, reject. But there are 2 very important exceptions. So when we are so the first exception, when we are evaluating a project that has cash flows that have unconventional cash flows, then using IRR will be problematic. So what do I mean by non-conventional project? A typical project we have used has an initial negative cash flow at the beginning, but later positive cash flow. So make an initial investment, cash outflow, negative cash flow now, and in the future positive cash flows. So that's by that I mean conventional cash flows. But not every project has conventional cash flows. So some, for example, an auto company that makes cars. So the auto company may consider whether to sell this kind of warrants or not. So selling warrants. So if that's the new product, selling this kind of warrants, will this generate value for investor, for the company or not? So what's the nature of warrants? Warranty, nature of warranty. Consumers, so car buyers, if they decide to buy the warranty, extended warranty, from the company's point of view, they received a warranty premium payment from the customer. So that's initial cash inflow. But later, when the part failure or there is some mechanical problem in a part of that vehicle, the company who sold the warranty to the car buyer should make a payment to the mechanics, the service department, to fix the car. So in the future, there may be some cash outflows because of the inflows, cash inflows received. So that's the opposite case. So that's a non-conventional cash flow project. Another example of non-conventional project is a nuclear power plant. So suppose you're analyzing, you work for an energy company, and the business new project is building a new nuclear power plant, And then what happens? Initial investment is huge, so negative cash flow. And down the road, the power plant, nuclear power plant will generate cash flows. But at the end, what happens? When the life duration of the nuclear power plant is over, there will be a huge cost of cleaning up the remainder. So environmental cost at the end will be huge. So the huge negative cash outflow will be waiting far away near the end. So that means cash flow started from negative, positive, and huge negative will be later. So cash flow changes signs more than once. So I just used the two simple examples, but in the real world, there can be many other examples that of projects which cash flows change signs many times, so more than once. In that case, don't use IRR. IRR will give you a very weird result. So, but no matter what kind of cash flow we are looking at, NPV is always consistent. So that's why you need to use NPV. So another case where IRR becomes problematic is, excuse me, another case where IRR gives an unreliable result is when we evaluate mutually exclusive projects. So when what do we mean by mutually exclusive projects? So if we do one thing, if we accept one project, the other project cannot be accepted. So that's an example of a mutually exclusive project. So for example, if you're looking at a semiconductor company producing like Intel, some company like Intel, which is producing a semiconductor, and the company needs to build a new plant to produce 100 million more units of the specific CPU product. 100 million additional units are needed, and Intel is considering whether to build a new plant in California versus Arizona. So California project and Arizona project, those are mutually exclusive projects, because 100 million unit CPU plant in California, 100 million units plant in Arizona. If Intel decides to build it in Arizona, California project will be rejected. So those are mutually exclusive project example. So when a company evaluates those mutually exclusive projects, IRR may not be giving the best answer. So IRR and NPV may give different answers. So in that kind of situation, definitely use NPV. So especially when we evaluate mutually exclusive projects, if two projects have significantly different initial investments, so the issue of scale and timing of cash flow is substantially different, this difference, the problem caused by IRR will be huge. So these are called issue of scale and issue of timing in the evaluation of mutually exclusive projects using IRR. So these slides explaining those issues. So first, IRR and non-conventional cash flows. So when the cash flows of a project change signs more than once, there is more than one IRR. So when you solve for IRR, you're solving for the root of an equation, and that crosses the x-axis more than once. So IRR, we have two IRRs. So which one should we use? So that's why IRR gives a very confusing picture when there is a non-conventional cash flow changing signs more than once. So here is an example of also here is a numerical example. Suppose you are looking at an investment project that will cost 90,000 initially. So that means year zero cash flow is negative 90,000. And year one cash flow is 132,000, year two, 100,000, year three, negative 150,000. So the required return is 15%. So should we accept the project or reject the project? So think about it. So while you think about it, I will take a screenshot to make sure I give you the right attendance points. So I'm taking a screenshot. Okay, the screenshot was not taken properly, so I'll just do it again. Go back to the Zoom meeting, take a screenshot, and then copy it to my address book, my attendance record file. First page taken, so I move to the second page, and then print. And then I copy the second page. Okay, now I'm done with the screenshot. All right. Okay, so attendance taken care of. So if you don't have other questions, I'll go back to the slide. So in this kind of non-conventional cash flows, so if you use this time 0, time 1, 2, and 3 cash flows, and you apply numerous. Wade, do you have any questions? Zaid, Bain, do you have any questions? If not, I will mute you. Okay. Okay. So this is the NPV profile of the numerical example. So as you see, when we vary the discount rate, NPV changes. So the discount rate that makes the NPV equal to 0, there are two discount rates, 10% and 42%. So it's not clear which one is the IRR of this project. But if so in that case, we need to use NPV. We need to estimate what's the right discount rate. So for example, if it's 15%, NPV is positive, so accept the project. But if the right discount rate is 25%, for example, if the right discount rate